So hello everyone, and this is now part 2 of chapter 9. This is where we left off. So I want to go through this example here. So Dutchess Corporation has this 21% tax rate, right? And this is what their before tax debt cost on bonds, right? This is what they pay the bondholders before taxes. And as I said, they can write this off and lower that, right? So we find the after-tax cost of debt by simply taking the before tax and multiplying it by 1 minus 0.21. And we get the after-tax cost of debt is equal to 4.88. So if Dutch's interest expense reaches 30% of EBIT, then any additional interest expense is not deductible, and for any additional borrowing, the before and after-tax cost of debt are equal. Recall that when bondholders purchase a Dutchess bond at par value, they expect to earn a 6% yield to maturity. Incorporating the issuance cost and the tax benefit of debt, the firm's after-tax cost of debt is 4.88. Quite a bit less than the 6% return offered to bondholders. So you see they're getting a break. They're writing off the coupon interest. That's why companies love issuing debt. In most cases, debt is the least expensive form of financing available to a firm. Debt is a relatively inexpensive form of financing for two main reasons. First, debt is less risky than preferred or common stock. That alone makes debt a low-cost form of financing because investors accept lower returns on bonds than on stock. Second, the firm enjoys a tax benefit from issuing debt that it does not receive when it issues equity capital. The bondholders get paid first if the company goes belly up, so they don't have to. They get a smaller coupon rate because they're senior to the common stockholders, so they'll get paid first. So they're senior, and then the preferred stockholders are next, and then the common stockholders. Okay. So you can see here's the tax benefit from issuing debt, right? All right, Kate and Kasem Sullivan, a married couple in the 28% income tax bracket, wish to borrow $60,000 to pay for a new luxury car. To finance the purchase, either they can borrow the $60,000 through the auto dealer at an annual interest rate of 4.5%, or they can take a $60,000 second mortgage on their home. The best annual rate they can get on the second mortgage is 5.5%. And they've already qualified for both. So you can see if they take a second mortgage, they can write off the interest. That'll lower the, because they're in the 28% tax bracket, right? So let's see which one's a better deal for them to take. Let's see which ones. So if they borrow from the auto dealer, the interest on this loan will not be deductible for federal tax purposes. However, the interest on the second mortgage would be tax deductible because the tax law allows individuals to deduct interest paid on a home mortgage. To choose the least cost financing, the Sullivans calculated the after-tax cost of both sources of long-term debt. Because interest on the auto loan is not tax deductible, its after-tax cost equals still 4.5%. And because the interest on the second mortgage is tax deductible, you can see how it lowered it. See right here? It was 5.5, but because they can write it off, it's 3.96. Because the 3.96 after-tax cost of the second mortgage is less than the 4.5% cost of the auto loan, the Sullivans may decide to use the second mortgage to finance the auto purchase. Okay, so here's the cost of, now we're going to talk about preferred stock dividends. Let me highlight that so everyone sees it's preferred now, right? So preferred stock dividends are when companies issue preferred shares, the values usually pay a fixed dividend and have a fixed par value. So I'll highlight this so everyone knows we're talking about preferred, right? We're talking about preferred. Yeah, all right. So calculating the cost of preferred stock. So this is the cost of preferred stock, all right? And this is the required return on preferred stock, and it's equal to the dividend, okay, over the net proceeds from when they sold the stock, okay? So this is how much they got when they sold the stock, and this is how much they got to pay out in dividends, and that gives them the required return, okay? So so that's it for that shit. That's pretty straightforward, right? If you have any questions, you let me know. So this is just the 9.3 in your book. All right, so Duchess Corporation is contemplating issuance of an 8% preferred stock they expect to sell at par value for $80 per share. The cost of issuing and selling the stock will be $2.50 per share. The first step in finding the cost of the stock is to calculate the dollar amount of the annual preferred dividend, which is $6.40, right? You can see it's 8%, right? 8% here on 80. The net proceeds per share from the proposed sale of stock equals the sale price minus the flotation costs, right? And that's $77.50. Substituting the annual dividend of $6.40 and the net proceeds NP of $77.50 into equation 9.3 gives the cost of preferred stock. So here's the cost of preferred stock, 8.258. All right, now we're going to do common stock, right? So now we'll do common stock. Let's highlight common stock. Let's do that. Finding the cost of common stock equity. So common stock equity is equal to the required return on the company's common stock, right? So let's highlight. Let's make sure we're clear. Common stock. And in the absence of flotation costs, thus the cost of common stock equity is the same as the cost of retained earnings, but the cost of issuing new common stock equity is higher because there's going to be flotation costs, right? So here's the cost of common stock equity. And it's equal to the next dividend. This is the price per share, which we already talked about, right? This is existing stock, right? And this is the required return on the common stock, and here is the constant rate of growth, okay? So remember we talked about the constant growth valuation or the growth model. If there's growth on the dividend, the dividends may not have growth, and this may be zero, all right? So it all depends, right? But if there's a growth factor, you just pop these numbers in, right? So here's that equation again. All right, so here's another example. And you can go over this. This is from your book, example 9.8 from your book. Go over this and you can see how, if you have any questions, email me, all right? So you just pop them. Here's the numbers. You just pop them into this equation again. And you end up with the cost of common stock equity here. And, all right. And here's the cost of common stock equity. All right. So that's pretty straightforward. If anybody has any questions, let me know. All right, so here is the, again, we're going to go, now we're back to the cost of common stock equity. This time we're going to do a different way of getting the required return. We're going to use the capital asset pricing model, which we already talked about, right? The capital asset pricing model. And this is going to describe the relationship between your required return, the risk-free rate, and the non-diversifiable risk of the firm, and of course beta, right? So this equation, you've seen this equation already. And like as I said to you, every stock has got a beta. And you could use this equation if you know all these items, okay? Theoretically, they should come out the same way as the other calculation, but a lot of times they don't, all right? Because each of these models is a little different. So here's all the definitions of that equation, which we kind of talked about already. And here's an example. And once again, they give you the beta, right? Here's the beta, 1.5, right? They tell you the beta. Here's the market return, 9. Here's the risk-free rate, 3. And that's it. You just pop away. And the required return comes out to be 12%. Okay? So you just use the capital asset pricing model on that. And it pops right out. So here's what they say. Notice that this estimate of the required return on Dutch's stock does not line up exactly with the estimate obtained from the constant growth model. That is to be expected because the two models rely on different assumptions. In practice, analysts at Dutchess might average the two figures to arrive at a final estimate for the required return on common stock. This is just what I was driving at. Okay? All right, I'll knock off here and I'll pick up a part 3. Whoops. I'll pick up a part 3, all right?